in the last year. MBS and Treasuries got pummeled, and the banks have not had enough capital for that.
I've just invited Wahid up. He's be coming up now. In the meantime, do you want to just give us a quick update on the markets, stock talk?
Yeah, I mean, not too much news happened here. Again, these stocks are just bouncing up and down, ranging off the bottom of these lows. I mean, most of them are still down significantly. Live Oak Bank, which is the name that I was personally short on, I talked a little bit about last week. That thing is just falling apart. It's down 40%.
MCB's
KRE, the
down
regional,
80%.
yeah,
That's the
there's a ton of
Elliott
them.
short.
Yeah,
Hey guys, I'm here.
there's a bunch that are just falling apart. KRE, the regional banking ETF, has been pretty pinned down all day. I would be surprised to see that get a sustained rally, looking at how most of these individual names are trading that are in those ETFs.
But stock talk.
Yeah, I mean,
Let's talk
the
about
markets themselves are trading relatively flat.
you mentioned the
Yeah,
concept of
sorry,
this
go for it.
implied guarantee. Should we be out in front? I mean, now there was always debate about too big to fail and whether the big ones are going to be step in and backstop them. But are you suggesting that there's a total implied guarantee of the entire banking system, regardless of what the FDIC has?
No, I'm not implying that there's an implied guarantee in the banking system, but I'm implying that there is a level of trust that is required to operate any banking system. I mean, we can't expect banks to have all of the money. Then banking doesn't work, right? I mean, conceptually, banking does not, the concept of why would they do it, right? If you expected a bank to take your money and just have all of it sitting in the back office, why would they
It
do?
would be
Why
like
would they
putting it in
bank?
a warehouse.
Exactly. Why would they bank? Why would they build the nice buildings and have the coffee in the lobby and have the guy who talks to you about, your loans and have all, they just wouldn't,
Isn't that the
it wouldn't be a
whole
business.
isn't that the whole Bitcoin discussion? Maybe banks don't need to be a
Yeah,
business
that
and
is the
can
Bitcoin
just
discussion. I
I
don't think
mean,
Bitcoin is the solution to the problem in banking at all. But yeah, that is, I guess, one of the narratives.
what about smart contracts and DeFi? I mean, is that not a solution to
I
the
don't
banking
think you
problem?
need any of that. I just think you need, again, I don't have the playbook spelled out like, hey, banks need to do X, Y, Z and need to regulate this, and this should be the capital tier one capital ratio, and these should be the reserve requirements. I don't have objectively the numbers sitting on a piece of paper
Hey
where I could
Mary.
go submit them. But what's
And
more
you don't
important
even necessarily need to have those requirements as long as you say, okay, you can have very low capital requirements, just have an interest rate hedge. That solves the
yeah,
entire problem.
exactly. I mean, again, there's some kind of protocols or regulations that can be put in place. There's a balance to be found between, the idea that, you know, I don't want to say people should understand that banks are inherently insolvent, but with enough pressure, any bank in the world could become insolvent, right? And we're in a unique environment right now where, because of this dramatic move in rate hikes, which, by the way, I agree with. I think we should have tightened policy in the face of this inflation. I'm not saying the Fed did the wrong thing by raising rates, but the pace of the rate hikes was one of the steepest pace of rate hikes that we've ever had. And as a result of that, yeah, these banks got put off sides on their exposure to long-term treasuries. And we've belabored this point over the last 4 days. That's all anyone wants to talk about. That's understood, okay? But even before that, with or without any kind of error in the exposure to treasuries, we already know that conceptually banks cannot service X percent of withdrawal requests
So
in a
this makes
short enough
this
period of
makes
time.
it a game of trust. Like I want to go back to Wahid. Wahid, you talked about this earlier,
Yeah.
and you mentioned some pretty big numbers. Can you talk about them again on why you think this is not just mitigated to Silicon Valley Bank and a few regional banks,
Okay.
and why you think if the Fed doesn't step in and the interest rates continue to hike, this could get a lot uglier? Because you've been saying this for months.
Oh, okay, awesome. So just in disclosure, Mary asked me to just jump on. I've been on conference calls nonstop, so I'm not being rude. I apologize if I have to drop off in 10 minutes. Um, so you want me to go over the highly leveraged economy? I think people are sick and tired of me saying that, but here are the numbers. It's
Talk
330.
about that, but also that, and also your response to the market and Biden's speech.
Okay, well, all right. Okay, let's talk about the market. I'm talking a lot of hedge funds. I mean, we have an internal hedge fund. We're mostly private equity, but we're in the markets. We basically the consensus on why banks shares are going down is they can no longer be priced. Let me explain. The fear is not deposit outflows, right? It's because that's sort of covered unless it's completely overwhelmed, which I don't think is going to happen. It's the new stress tests that they're going to be unleashing now, because the Democratic Party and also the Republican, frankly, they're only going to go down this road over the next 48 hours if uh, uh, savings and loans banks use the next 12 months, and preferably very soon, to issue a lot of capital, and they don't give a shit about the shareholder return. Okay, so that is the moral hazard they want to just take out of the window, right? So that's why the bank stocks are basically trading so low, because they're going to have to be highly diluted. And that brings me to the Biden speech, because the Biden speech is 100% that, right? He wants to take the victory lap and saying punishment, 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 change of boards, change of management, change of everything. So, and I think the candidate list of the banks that are going to be forced to do highly dilutive equity is anyone with a duration mismatch. So you can come to the Fed window, you can tap the bailout fund. They'll give you a timeline, but they're going to change the management team, they're going to change the board, and they're also going to issue a lot of equity in order to dilute shareholders and shore up the capital base. That's why the stocks are going down. That's my view. On the aggregate debt, there's only one. A lot of people here very smart debating the solutions. Unfortunately, the solution is staring us like a deer in the headlights. It's the Fed, right? They have to unfortunately capitulate. It pains me to say this because I'm a hard money guy, but that's the reality, because the numbers just don't lie. The 330 trillion of global sovereign debt, what we have in America, pales into is so much more mild than the shadow banking system of China, the huge real estate debacle going on there in terms of hidden debt. In aggregate, we have 330 trillion of global sovereign debt. We have 180 trillion of consumer and corporate debt, and we have around 220 trillion and change of unfunded liabilities at the pension fund level. Those numbers, if you just do any math, you'll see that the swing on 100 basis points of interest rates is just too dramatic. That's why, unfortunately, or fortunately, depending on which end of the fence you are, the Fed just has to capitulate, because the system, there'll just be perpetually a run on the system. Okay, everyone wanted to wait for something to break. Now it's broken. Confidence is lost. Don't know if I answer your questions, Mario.
But if inflation, if CPI doesn't subside,
So this is what's
does the
crazy. It's
CPI will subside. This is a deflationary
there's a
issue.
deflation. The two things. One, I agree with that. Two is there needs to be a time, guys, where the market has to do self healing. Okay, the economy has to do self healing. That's the problem. It's the 30, 40 years of perpetual intervention, where they're trying to outlaw recession, outlaw fixing the system naturally. The reason we have inflation is not demand, it's supply. It's the supply side of the curve. And the Fed has no tools to fix that. You need deregulation. You need, in terms of oil and gas and commodities, you need to be able to allow people to fix the supply curve. You need, less stringent employment mandates and regulations. So that's what's going to fix the system. And unfortunately, it's long term, right? Or you can do it the hard way, which is
But
creating a
not
recession.
one of those measures, Faith, would have saved this bank in the case of a $42 billion bank run. Nothing you mentioned would have saved the bank.
Point being,
Not
sorry, I
one thing.
apologize. What was the point?
That's the point.
So no,
Is that's not that those things aren't solutions. Like there's a need in these types of situations, and it blows my mind. I don't understand it. There's a need in these types of situations to drag the narrative into larger, macroeconomic issues that frankly, whether you agree need to be addressed or not, have very little to do with this happening.
So I agree
right?
with you 100%.
And
You're saying, Wahid, we can't fix the supply side. I agree with you 100%. Frankly, we don't have the
no,
government.
that's not what I'm saying.
But
Can
the Fed
I?
has to lower rates.
Everything you brought up, none of those things, even if we snapped our fingers and magically changed all of that, would have prevented this.
Totally agree, Stock
Um,
Talk. This was
it's just
mismanagement at a micro level.
it was
Can I talk about
mismanagement
inflation?
combined. It was mismanagement combined with a corralling of sentiment that would have been very difficult to do at most banks.
Right.
But
So when
because
you
of
have
the
cancer,
centralized,
the mildest thing can cause your death. That's
right,
outside
right,
cancer.
is what I'm saying. And so none
Okay.
of the
Right.
structural or macroeconomic, narratives that have emerged from this have anything to do with anything, frankly.
Well, it
And I'm
does,
not
because
knocking
if
what
you
you
don't
said.
have liquidity, you're
I'm
going to
not
get
knocking what you said, Faith. I'm just trying to refocus the conversation because, again, the fallout from this, the implications of this, everyone's going to want to itch for these huge, structural reforms. But even with those reforms, this could have still happened, and in fact, would still happen in that imaginary, hypothetical, transformed ecosystem.
Guys, can I just mention something about inflation? One of you spoke about the inflation problem not magically going away. Remember that how they measure inflation is they measure inflation year on year. So they take last year February and they compare it to this year February, and they tell you that inflation has gone up X amount of time. We saw a massive inflation spike last year, I think around May or something. That is kind of when inflation peaked. And so when we start measuring the increase on the May, June, July numbers, we'll realize that actually the increase on the base, which was May, June, July last year, actually isn't that high. Now in February, it is a bit lower. In January, it was a bit lower. But when we start measuring year on year, May versus May, and February versus February, and March versus March, we'll realize that the inflation numbers are automatically going to come down. So if I look at the January inflation last year, January inflation was 7%. But then if I look at June inflation, it was 8.6% and July was 9.1%. Now, when your base gets higher, when the number that you're measuring against gets higher, naturally, because we've slowed down the economy, because your base is higher, you're going to get the number coming down. So I think that we have to wait until around April, May, for that to actually filter into the market.
Yes, it's going to fall dramatically.
Let me read out briefly, and I want to introduce Michael to get his thoughts on this. I'll just read out a note from Goldman Sachs, just kind of 2 quick points from that. Not sure if anyone's read it. In light of recent stress in the banking system, we no longer expect the FOMC to deliver a rate hike at its March 22 meeting, with considerable uncertainty about the path beyond March. We have left unchanged our expectations that the FOMC will deliver 25 basis point hikes in May, June, and July, and now expect it to 5.25 and 5.5% terminal rate, though we see considerable uncertainty about the path. So it just came out 4 minutes ago. Michael, would love your thoughts. Thanks a lot for joining us. I know it's your first time on Twitter Spaces, and would love your thoughts.
Thank you. Yes, it's my very first time on Twitter Spaces, so this is exciting for me beyond all the excitement that we had over the weekend.
This is a good place to make it your first.
Yes, thank you. I think a few things. I think that while it's true that the newspapers report inflation on a year-over-year basis, comparing March of 2023 to March of 2022, the Fed is doing much more sophisticated calculations that involve a range of measures, including shorter-term measures. And so I don't think that inflation measurement will be a serious factor in the Fed deciding what to do. Second point about the broader implications. Right now we're seeing a tightening of financial conditions. We're seeing stock prices go down. We are seeing bond prices go up. And that is kind of doing some of the Fed's work for it. We focus a lot on interest rates, on what the Fed does to interest rates. But the Fed doesn't care about interest rates per se. What the Fed cares about is broader financial conditions. And the Fed uses interest rates as a way to affect broader financial conditions. And so this is, I don't think this is a disinflationary event, but so far this has been an event that has tightened financial conditions, which means that the Fed, has less tightening to do using its interest rate tool. A third observation is I think the broader macroeconomic effects of this will be very limited, and my suspicion is that a month from now, apart from people in the venture capital community, apart from people in the Silicon Valley community, and apart from people in the regional mid-sized banking community, we won't really be talking about this anymore. I think the Fed has stepped in. The terms of the new lending facility are very generous to borrowers. I think because the Fed expects that the probability of having to actually incur any losses on that facility, the probability of any of the capital that Treasury put up actually having to be used is extremely small, and so this I think will serve to stabilize the situation. People are still going to get paid their salaries. The businesses that have deposits in these troubled institutions will experience nothing more than a stressful weekend. They'll still be able to make payroll today. They'll still be able to make payroll tomorrow, and this will not have implications for the broader economy. What does
So
that
if
mean?
that's the case, then Goldman could be potentially right in that maybe they skip the March meeting, things go back to normal in April and May, and we get 3 hikes into July, and we go back to 5.25 to 5.5.
So I don't think they're going to skip. I think Goldman's wrong. I think
They
this
could be.
may.
I'm not saying they're right, but I'm just
Yes,
saying the idea that they slow down and then start up again could make sense.
and I think the slowdown will be. I think that qualitative story is right. I suspect if there's going to be a slowdown, it's going to be the plan was to raise rates by 50 basis points in March. Now the plan will be to raise rates by 25 basis points in March. I think the Fed should still go with 50, but Goldman's expecting 0, and I think that's that will look like an overreaction.
If the Fed go with 50, like you think, what happens to the rest of the banking system? I mean, it's I agree with you. We've got a big inflation problem, and it's easy to say the Fed should carry on going with 50. But
Yeah, I don't think they can do 50. It's going to make the held to maturity issue and the securities, mark to market issue a bigger problem.
It'll make those a bigger problem, but those are going to be a problem. And the Fed, look, the broader macroeconomic situation, in my view, is very clear. The Fed has to go considerably higher than it currently is, and whether or not
What is considerably higher to you, Michael, on the Fed
I
funds?
think above 5.5. So right now we're at roughly the federal
So
funds rate.
why policy wise, Michael, do you feel that way? Because I mean, okay, look, I understand over the last 2 months, the suggestion that the labor market is stronger than expected, the suggestion that consumption is stronger than expected, the suggestion that inflation is resurging. But do you not expect any pullback in the general inflation metrics in the second half of the year? Do you think that we're still going to be raging red hot to where it's not about holding rates above 5, but really getting above 5.5? Because I hear this policy advocacy from people, more and more now, especially in this part of the year, that we need to go above 5.5 because we saw a blip back in inflation over 2 months. But when it came to the flip side of the ball, and we saw it deflating data for 2 or 3 months, the first thing those same people were saying was, well, don't rush to call it deflation within 2 months. And it seems that now those same people are calling this reflation within 2 months. So why do you feel specifically that we need to get above 5.5% to make an impact here, as opposed to staying where we are for an extended period of time.
I do. Before you answer, if you don't mind, I'm just gonna give Michael just two quick updates. So Bill Ackman, who was on the show yesterday or the day before, he just says regional bank stocks are a quote incredible bargain, and then another quote for anyone in crypto: OKCoin has suspended U.S. deposits because of Signature Bank and because of their closure. So two quick updates. But Michael, go ahead. Yeah, go ahead, right?
Yeah, so I agree. I agree with Mr. Ackman that regional bank
And
stocks
why
are,
is that, Michael? What brings you to that conclusion?
because I think that what the Fed and the FDIC have done will eliminate any contagion.
To what extent?
And
To what
that
extent is it enough? If you don't mind me asking, Michael. Like, they've done enough. To what extent? Like, what level fear could there be where even they need to do more?
they've calmed the panic, and the terms of the lending facility are quite generous, and